In the world of investing, Roth IRAs are a favored child. What's not to love about tax-free growth in your retirement savings? Find out all you need to know next on Consider This Program. Hello and welcome to Consider This Program. I'm your host, Jamie Burton.
And I'm Darren Hardesty.
Great to have you here today, Darren.
It's good to be here.
We have a very fun topic to talk about today, one that we love to talk about when we are meeting with our families, and just the benefits that go into what we're talking about today, the Roth IRA. It is a vehicle that is not taken advantage of as well as it should be, but if you do the proper planning, the Roth IRA can be a huge asset for you in your future when you do get to retirement, and also for your beneficiaries when you leave them a legacy when you pass away. So
Absolutely.
We're definitely going to hash that out today. But what are some key things that people need to know about Roth IRAs?
Yeah, the Roth IRA, as you said, Jamie, it's one of our favorite things. Of all my personal friends, whenever they ask me, they ask for stock tips, and I'm like, hey, that's not my cup of tea.
Sure.
But I can tell you, are you putting money into a Roth IRA? And most of the time, they ask me after that question just because they're not quite sure. They think it's a product of some kind. They're saying, well, what kind of return can I get in a Roth IRA? And I'm telling them, no, it's not about return. It's invested the same way as any other investment account. It's about the tax. And you are willing to make the sacrifice now, this year, and the year that you put money into the Roth IRA, pay tax on that money before it goes into the Roth, and then not be taxed on it on any of the growth or when that money comes out as a distribution when you get to retirement. And so right now, the Roth IRA started in 1997, I think was when the legislation actually put it into place. And so there's not been a whole lot of people that have put, where they're sitting on millions of dollars in their Roth IRA the same way that they're looking in their 401k or a traditional IRA. A couple reasons for that. 401ks didn't have a Roth option for many years. And that's where the vast majority of, the standard middle America, middle class person who's saving their money every paycheck is putting money in their 401k. More and more 401ks are allowing a Roth option where people can put money into that. So again, the general rule of a Roth and the deal that the IRS is making with you is, I will let you be taxed today, but I'm not going to tax you when this money comes out. And we wonder sometimes how long this is going to last, because we think that the IRS has got this backwards, because we see what a great deal it is for those who take advantage. But there's nothing in the cards right now that says the Roth is going anywhere. Might be taken away from maybe some individuals who make too much money, or I say too much for those bad people that make too much money. So that might be going away for them at some point. I still don't understand that rule, because they're the ones paying the most tax to do it. And it's limited on how much you can put into the Roth right now. If you're over 50, you can put $7,000. Under 50, you can put $6,000 each year. So it's not like you're putting all your assets there. But it's a great place to be. Tax-free growth. You're going to get it out tax-free down the road, and that's all stuff we'll hash out more too.
Yeah, absolutely. And you were also talking about having a Roth option inside of the 401k, right? So does that mean that inside of your 401k, you can have all of your money in the Roth side?
Yeah, well, that's a great question. So it's all about your contributions. So most 401ks, you're going to have your employee contribution, which is what you put in, and then you have your employer contribution, which is what your employer puts in. The employer contribution has to be tax deferred. That's a rule that for them to get the tax deduction at the end of the year for making contributions to their employees' plans has to be in a tax deferred side. As an employee, though, you can put all of your contribution, the maximum amount, all that into the Roth side. Depending on your income and depending on your situation, if you can, we would tell our families to max that out every year. And what's great about the 401k is that you can actually put more into the 401k than what you can into the IRA. Sure. Very similar rules, but they follow different tax codes. So in a Roth IRA, if you're under 50, you can, like I already said, you can put $6,000 a year as of now. If you're over 50 or 50 or older, you can put $7,000 a year. That will probably increase every 2 or 3 years. But inside of a 401k, the rules are different. In 2022, you can put up to, if you're under 50, $20,500, and then you have a catch-up provision to put up to $27,000 if you're 50 or older into that portion of your work account. So those rules don't coincide either. So I can max out both if I wanted to, if you were so blessed to have enough to do that. So it's just another vehicle, another place that you can put more of that after-tax money in.
Absolutely. So if I have a Roth IRA that I have opened up and
Mm-hmm.
I am contributing to it, when can I access what I've put in, and when can I access the growth?
Great question. It just depends, I guess. So Roth IRA's another benefit is that because it's already been taxed, the IRS allows you to take any money that you've actually put in without penalty. You can take that money out if you need it. Where a traditional IRA that's tax deferred, you're going to get taxed on it at your income rate plus a 10% penalty if you take it out before 59 and a half.
Mm-hmm.
So most people think, well, if that's the rule for a traditional IRA, it must be the same for a Roth. Not so fast. You can take out, if you put money into that Roth, I put $6,000 in this year, I can turn around and take that $6,000 right back out. What I can't touch without penalty is the growth.
Okay.
So if I've put $6,000 in, it grows to $12,000 before I'm 59 and a half. If I take out that $12,000, 6 of it is going to be taxed as ordinary income, plus it's going to get the 10% penalty if I take that out before 59 and a half. So there's some rules there. The idea is that if you put money into a Roth, even though you can take it out, the basis you can take out without penalty, it's still a good idea to think of it as long-term and not touch that. That's very special money that you don't want the compound interest formula to get messed up on. You want that money to stay there and let it work for you for as long as possible.
Sure.
There's also, Jamie, a 5-year rule. And it's kind of a confusing rule. And all it is that you can't take growth out of the account, out of a Roth account, until it's been open for 5 years. So if I open an account, and it's funny how the rule works because it's not actually truly 5 years necessarily. If I open an account on December 31st of 2021, the IRS is going to read that as if I opened it up on January 1st of 2021. But I have to wait 5 full years before I can actually access that growth without there being any penalty. Even if you're 59 and a half or older, you still have to have it open for at least 5 years. So it's important that you get those Roth IRAs opened as soon as possible, get them funded, get $1 in, get something in to get the 5-year clock started.
Mm-hmm.
As long as you've done that early on, you really have nothing to worry about when you get to retirement. The 5-year rule, though, does kind of work differently for conversions. So we can kind of talk a little bit more about conversions here in a few, too.
Sure. Yeah. So I had a family come in, and you were alluding to conversions, but they came in, they worked for 35 years for CAT up in Lafayette, and they had saved all 35 years into their 401k, and it all went into the tax deferred side. And she was like, Jamie, like, I was told all these years that this is what made the most sense, to defer all of my money and save all my taxes today, because when I get to retirement, I'm going to be in a lower tax bracket. And that's what I was always told. Why did nobody tell me about the Roth side? And I kind of had to explain to her, like, the Roth wasn't an option until 97, and it wasn't an option in your 401k till much later than that. So
Sure.
You did what was right for the time when you were saving. Like, yeah, that made sense. But there were some changes that were made that nobody advised you of. But because she has all of this money in the tax deferred side, is she stuck?
No, she's not stuck. And, I always want to make sure I give grace to families that come in because in our minds as advisors, we know, hey, Roth is so important. We know how great it is. But, most families, if they've come in and they've saved, every paycheck and they've done everything that they can and it goes into tax deferred, there are worse problems to have.
Yes.
But at the same time, no, you're not stuck. And the comment about, that, we thought we paid a lower tax rate. Well, anybody who tells you that they know what the tax rate's going to be in 20 years, how do they know? All I know is it's probably not going to be the same as it is today.
Sure.
And most likely, based off how it feels right now, it's probably not going to be lower. It may be the same, but it's probably not going to be a lower tax rate. So a lot of things have to happen that you don't know for sure. So in our mind, it makes a lot more sense. I'm going to go ahead and pay tax on what I know now and not let the IRS dictate the rules later. What most of our families, though, there's a gap time for a lot of families that come in when they retire. About 65 is a pretty normal time to retire. And now they have less income because they're not working full time. They're only pulling what they need from their accounts. What we'll do is we'll do conversions inside of a preferential tax bracket. So I've got multiple families that every year from 65 until they get to 72 when they have to take money out, and also when 70 when Social Security kicks in automatically or it's forced upon them, and their AGI is lower because there's less going into that calculation, we can convert money from their traditional IRA into their Roth IRA. And so when you're converting that money, it's not a contribution, it's a conversion. You can put as much as you want, but we do as a simple calculation of AGI to say, hey, I can convert $20,000 at a 12% marginal bracket. Federally, we like that number. We're going to get that $20,000 out now at 12%, and it's never going to be taxed again, and it's not going to be forced to be taxed at a higher rate potentially down the road when they have to take it out when their required minimum distributions kick in. So lots of complicated moving parts. It's hard to kind of summarize it all easily. All we can say is that getting money into a Roth IRA is a great idea. Putting more into your Roth 401k is typically a great idea. If you're not sure if it's a great idea for you, give us a call. We are here to make sure that we can help you out and get through those difficult decisions.
Absolutely. And like you said, it's so complicated and each person is different. So we really have to hash out everyone's individual situation to determine if the Roth conversions make sense for them and how much it makes sense for them. So it's a complicated thing that you really need to talk out with somebody who does this every day.
Yes.
You can reach out to us here at Financial Enhancement Group at 800-928-4001. Ask for Brittany, and she can set up a time for you to come in and talk with one of our advisors. We're going to give you some ideas to think about what you can do today, what you should do in the future, and if we decide to partner together, what FEG will do for you going forward.